All right, everyone. I want us to look at the types of liquidity that we have in this market and their use case scenario. Remember, I talked to us about where to find liquidity and what exactly is liquidity. We've gone through all those things, but then what are the types of liquidity we're expected to see on our charts? Now, briefly, we have two major types of liquidity. Namely, we have the buy side liquidity and the sell side liquidity. I'm going to explain what the buy side liquidity for you and also a sell side liquidity. Now, whenever you hear the word buy side liquidity, is any form of liquidity that is found above price on the upper side of price. And then the sell side is any form of liquidity found on the lower side of price. I'm going to show you that when I go to the charts, but then just have an understanding of this. And then there are other forms of liquidity called external range liquidity and internal range liquidity. The best way I can explain this to you is when I go to the charts. That is why I want to go to the charts and show you these forms of liquidity and how you can identify them, how you can also use them for your own advantage. Now, remember we said that we have two types of liquidity, majorly the buy side liquidity and the sell side liquidity. Now, this is how to use these types of liquidity. Whenever you're going to use the buy side or the sell side type of liquidity, it is expected that you are looking at a high or a low. Remember we said that liquidity can be found either above highs or lows that we have in the market. But then preferably when you are dealing with buy side liquidity and sell side liquidity, use old highs and old lows, because the longer an area that is an old high or an old low stays, the higher the liquidity density around it. So let me take this for example. Let's say this area. Can you see this is an old high, right? So it is assumed that this place accumulates a lot of liquidity. It is accumulating a lot of liquidity. That means all the liquidity resting here is assumed to be a buy side liquidity. You see that? That is why you're going to see price comes in the future. Mostly it is dealt with in the future, the nearest future most of the time. All right. We also have liquidity that is found internally. We're going to talk about it when we talk about the external range liquidity and internal range liquidity. But then this one, they are mostly found above highs and below lows. So this is a buy side liquidity. Why? Because it is above price. So when price targets that area, it is a buy side liquidity, and it is a type of liquidity that the smart money use to frame their model. They call it the market makers buy model or the sell model. When they clear such kind of liquidity, you will see reversals. Most of the time, the buy side liquidity and the sell side liquidity are liquidities that when you see price clear them, you're going to see a short time reversal or a short time change in the range. Just like this one, you can see we have sell side liquidity resting here below these guys. And after clearing that, we saw price did what? Is now shifting back into this area. So when you look at a very big range, mostly you're going to see buy side and sell side liquidity. This one too is a buy side liquidity. What do you see? Price came and cleared that. It stayed for a while before price what? Cleared it, and we had a short time reversal. So if there is anything you shouldn't forget in this particular type of liquidity, is that it is a type of liquidity that we see price dealt with when we are about to see a reversal, mostly external and internal. You can see them. This is what? A sell side, and this is a buy side. So above highs and below lows, this is where you're going to see them. Let me see if I can see another one. I can show you a buy side. Okay, this one. Remember I said they are mostly going to be there for a while before price finally comes to clear them. And if you are framing a model of a reversal strategy or a kind of trend continuation, these are the things you use. It stayed for a while, price came right above it, and we had a short time change in what? The direction of this particular entire range or trend, and it came down to this area. You're going to see it like that most of the time. When you see an area stayed for a while, it will take a while before you see price come and clear that external range liquidity before it continues in that direction. So how about the external range and internal range liquidity? Now, for an external range and internal range liquidity, their use case scenario is a little bit different from this particular one I showed you. This one deals with the bigger perspective of the particular range you're dealing with, but then this one deals with how price moves in a particular trend, right? So let me show you an example. Remember, we did market structure that we see price creates maybe a high and then retraced, takes out a high and then retraced, takes out a high and then retrace. Now, this is what we mean when we talk about external range liquidity. We said that this place is liquidity, right? This is an external range as far as price is concerned, because we are dealing with this is an uptrend. We're dealing with an uptrend and we have liquidity resting above here. The moment price leaves a high, before it comes back, we have liquidity there. So this is an external range liquidity. It is outside the range because the range is basically from here to here. So this low is also having external range. This one is also having external range. So the only place you see internal range is within this area. This is the place you're going to see internal range, regardless of how big this frame. This can be on any time frame, all right? So internal range liquidity are mostly found inside fair value gaps, mostly inside fair value gaps and other institutional reference points. That is why we use the external range liquidity and internal range liquidity very closely when we are dealing with such a range. So in this case, this is a downtrend I have here. If I want to show you the market structure delineation here, I can call this area as an external range because it is outside the range here, because this is the range from this high and this, sorry, not that one. It's supposed to be from this high to this low. This is the high and this is the low. So when you're dealing with this high and the low, this is where the liquidity is resting. But then let's even forget about that and look at this particular area. All right. Can you see? We have this place because the moment price leaves a place, it's going to go back. We are dealing with this range now. We have this high and this low. Forget about the fact that price is coming back to this area. Let me show you that in simplicity. I want you to get this correctly, guys. All right. I want you to get this. So this is an external range. That's an external range. And this is also an external range, or you can simply call it out of range. All right, this is also an external range, out of range. But then the internal range is mostly where the fair value gaps are and other related institutional reference points. So when you see price coming back inside to get a discount, because definitely there are people selling, all this place is captured into this perspective. So when price is retracing back inside the range, it is now targeting the internal range, all the liquidity that is internally. You see that? So where the fair value gap is, mostly that is where the liquidity has a higher density, and this is an internal range liquidity. So anything outside is external. So when we continue downward to clear this one, we have cleared external range. Or if we decide to go back up to clear this one, we cleared external range. I think this is the easiest use case scenario I can give you. I know some of you were already taught how to identify these ones, but then not correctly. So this is where you need to see the difference. So if I call this now, let's use this for example. We have external range here and external range here. You see that? So price came all the way to do what? To clear external range, and it move out to clear another external range. It happens like that sometimes. And that is some of the use case scenario. Clears this one external range, but then when you are dealing with this new range, all right, this new range from here, this low, because this is the lowest area price pushed from to that level, creating this break of structure, which is also, let me say this, a break of structure can be an external range liquidity also. All right, it can be an external range liquidity also. So you can see price coming back to fair value gaps. All these ones are external range. I mean internal range, not external range. This is internal range, all of them are internal range. So the internal range and external range works on the basis of a trending market most of the time, when market is simply trending without any challenge. But then the concept of buy side and sell side works when we are dealing with a larger perspective of price. You're going to see price leaves a low or a high for a long time, and then it's coming back to target it before it have either a short-time reversal or a long-time reversal, like this one, price coming back to clear this guy before we saw a reversal into this area. So there is an entire model of trading using the buy side and sell side liquidity. All right, so thank you very much, guys. Let's go to the next video.